Alrighty. So I made this presentation really just to emphasize the importance of investing as early and as often and as much as you can, and as soon as you can. So the audience for this is really those that are maybe behind on investing, maybe haven't quite focused on their 401k contributions, or really don't really know anything about investing in stocks, mutual funds, index funds, ETFs, etc. So this hopefully this presentation makes it really simple. I really try to optimize for simplicity, because I know complexity can often be the thief of really wealth building over time. So let's dive into this. Again, the importance of investing now, as you can see here in the slide, your future self will thank you. As you see the older gentleman hugging his younger self, because his younger self did the right things early on in terms of investing. So let me move on to the next slide. So quick disclaimer, I'm not a certified or licensed financial, legal, tax, or investment professional. You can read the rest of the disclaimer here. You can pause the screen if you need to take your time and read, but I will be moving on. Now, there is an emergency that's happening, and really this is a crisis that is brewing. It has been brewing for some time. Many people are simply just not equipped financially. They are not ready for retirement. They are not ready for a scenario or a world in which they're no longer working or able to work. Most people are drowning in debt. As you can see here in the first bullet point, average household debt is $104,000. That's a lot of debt. And we're not talking about mortgage debt. We're talking about credit cards and car loans and the like, and student loans. The average credit card debt is $6,000. Again, if you have household debt of 104, you have credit card debt as well, you have other debt sources, it's going to be almost impossible to climb out of that unless you really hunker down and focus on where your money is going. 60% of Americans don't even have a retirement account. I'm going to touch on this a little bit in this deck as well. Like, retirement is critical, and a lot of people are not thinking about retirement. I know we live in a world where people jump from job to job, so you tend not to even think or track your 401k contributions and where they've been placed. You might not even be thinking about that at all. You're simply thinking, well, one day I'm going to start a business and become wealthy, and I don't have to worry about retirement per se, or 401k contributions per se. But hopefully this deck kind of centers you to reality, in that you do need to think about that. You do need to be concerned about that. More than 50% of Americans can't cover $1,000 emergency. Again, this speaks to the debt crisis, and people not necessarily being prepared for what's to come, and even unforeseen things like emergencies. Not having $1,000 in an emergency savings is bad. That's bad. So again, look, most people are essentially broke and will not retire comfortably or at all. Do not be most people, and hopefully this presentation will help you to achieve just that. So what should you be doing right now? First thing, get out of debt. You can follow Dave Ramsey's 7 baby steps. I highly recommend it. I've done it myself. It has gotten me out of debt a number of times throughout my life. So, I had a wave of, debt issues related to, like, let's say, student loans, after graduating undergrad, and I listened to a bunch of Dave Ramsey, and I quickly paid off those loans. But then I got right back into debt with credit card debt, and then I listened to Dave Ramsey again, and I got out of that debt. So sometimes you might need to watch it a few times, or to dive into Dave Ramsey's lessons a few times. But it's critical, and I think this is something that, if I were the president of the United States, I would mandate Dave Ramsey's lesson plans around the 7 baby steps to be taught to every single high school graduate, period. It's that crucial. So anyways, getting out of debt is critical. If you don't get out of debt, and then you try to follow the other subsequent steps, debt will inevitably eat away at your ability to contribute to the investments or your retirement, and it will eat away at your distributions, your ability to even make use of the income that could be generated from these investment vehicles. So that's why you do want to tackle debt as quickly as possible. I mean, like, get rid of it. You know, if you can get rid of debt very, very quickly, then you can see the other side of it where, okay, now you can engage in wealth building. Max out your retirement contributions. If you haven't done so already, you need to max out your retirement contributions at least up to your employer match. If you need to learn more about this, talk to your HR folks at work, talk to your tax accountant professional, and they can kind of help you understand, like, okay, how much you should be contributing, legally speaking, right? Because you don't want to go above your contribution max. Otherwise, you'll have to like get a refund from the IRS or something, or you'll have to get money back from your 401k account, brokerage, or whatever. So either way, you don't want to get into that mess. You want to make sure that you are contributing at least up into your employer match, if not maxing out your 401k contributions, your IRA contributions, if you're eligible. This is super important. If you do this early on in life, you can kind of pull back a little bit when you get older. But if you haven't contributed much to your 401k or your retirement accounts, then you need to do that now. You need to actually start maxing out like today. Do it right now. Like go log on to your 401k, whatever retirement thing at work, and then actually max out the contribution. Yes, you will take home less money, but it is better to do this now than later, right? Like adjust your cost of living to what your income actually looks like after 401k contributions. And last but not least, invest in your excess savings into a taxable brokerage account or an investment account. And this is what I will touch on for the majority of the presentation, what I really want to dive into. But again, all of these are super critical. In a way, the first two are in a way like kind of prerequisites to the third point about investing into an investment account. But nevertheless, they're all critical within themselves. Again, getting out of debt, super important. Maxing out your retirement contributions as much as you can, super important. And then investing as much as you can into a taxable brokerage account or an investment account. Now, why do you work? So the reason why, if you kind of think about this a little bit, the reason why you work is really to build what I like to kind of call a robot. So all the income you get, you're effectively investing that money, or as much as the income as you get, you're investing as much as that into your retirement accounts, a brokerage account, or taxable brokerage investment account. And in doing so, you're effectively really kind of building a robot that will inevitably work for you. So these investments will inevitably generate excess interest returns, right? It'll generate excess returns, and those returns you can effectively live off of. You can imagine if you were to, let's say, win the lottery and get $1 million, for example. If you put $1 million into an ETF that has a 10% rate of return, annualized rate of return, then every year you're getting about 100 grand every single year. And you never have to work again, because this robot, this $1 million robot, is basically giving you 100 grand every single year. So that's kind of how you have to think about it a little bit. People do this also with real estate. You invest in real estate, you own a number of houses, they generate income through rentals, and that income you can live off of. So in effect, those real estate is a robot of sorts. Same thing with the business. If you're able to build a business, in a sense, or businesses, those businesses could effectively generate revenue for you outside of your own contribution to the business, right? So if you don't work in the business, but you're simply managing it from afar, then that could be deemed as a robot that is doing work for you. So really, the crux of what I'm trying to get at here is that you don't want to get into this rhythm or this pattern where you're constantly trading your time for money, because inevitably, as you get older, as you have children, as you have a family, as you just simply get older, you're going to realize that time is actually incredibly expensive. It's going to become more and more valuable to you, such that you will no longer want to trade it in for money. right? But the hope is that you can put yourself in a position where you don't have to trade in your time for money, which again, your time is incredibly valuable. And instead, the robot or your investments will be generating cash for you, giving you cash so you can live your life and use your time in the best way possible. So that's really what I want to get, kind of the takeaway I want to put forth here in this slide. So let's go to the next slide. So why you should start investing now. Here's a good demonstration as to why investing early and often is super important. Here in this example, if you start with $1,000 balance in an investment account, you contribute about $1,000 into that investment account every single month, and into a mutual fund or ETF or index fund that gives off a 10% annualized rate of return. Over the next 25 years, you would effectively have $1.3 million, right? So this is a great example of just sort of saying, how much can I contribute every single month over a period of time? And then how much money would that then give me at the end of that cycle, or in this case, 25 years? Imagine if you started this when you were 25 years old, right? You got your first job out of college and you put $1,000 a month. By age 50, you'd have $1.3 million. And that's assuming you're not investing in anything else, not even your 401k or anything else. See, your 401k is also going to be invested in, your IRA will be invested in, and you would make it a point to invest $1,000 a month into your investment account. And by age 50, you could retire. Like, you're done working at age 50. If you put a little bit more in the starting amount, so let's say instead of $1,000 you had, 5 or 10 grand or whatever, you could retire earlier than 50, maybe 40 or 40, 45 or 46 or something like that. But basically, you get the theme here. If you start early and you contribute early in investing, both in your 401k or your retirement accounts and in your investment accounts, if you contribute early, if you invest early and as often and as much as you can, then you shorten the cycle of you having to trade your time for money, right? And effectively, you can retire early, or you can just retire in style, right? You can retire in a great fashion, right? Having money and being able to do things in your later years. So I put a link here to this calculator tool. You can play around with it, kind of see, what amounts you should start with and how much you can contribute every single month and so on and so forth, and see what that gives you within 20 or 25 years, and play around with that a little bit. But get inspired, because this should teach you, like, wow, if I can just invest early or as much as possible, or maybe if I could sell, those expensive pair of shoes, or sell this old car that's been sitting in front of my house, or whatever, and get that money and put it into this investment account and start contributing every single month, then what could that give me, right? So now you have an interest-bearing investment for you that will effectively work for you at the end of that investment cycle. So in this case, 20, 25 years. So again, here's another chart. By starting now, you can contribute very little, right? But you can earn big returns in your investment long term. So here, if you look at the yellow part of this bar chart, at that end, that last bar, that tells you how much the robot has generated in value for you. See, you've only contributed the green part, which in this case is roughly $300,000 over the course of 25 years. You've only contributed 300,000, right? But the robot, so to speak, has generated in excess of 700, maybe 800,000 or so dollars for you, right? Well, excuse me, I'm sorry. The robot really generated $1 million for you, right? Because the total returns is 1.3. So this is a great example of, like, what it means to, again, contribute early and often as much as you can over a period of time. Then at the end of that cycle, you will see that the robot is doing all the work for you. It's doing way more work for you. In fact, it's like you're multiplying yourself. Like, instead of just, you, one person working, putting in 300K, you have like 4 versions of you doing this, putting in 300K each. And then now you have 1.3. So again, a great example or illustration of what that looks like. But again, important to invest as early and as often as possible and as much as you can. So again, emphasizing time here for you and your timeliness of investing. Time goes by very, very fast, okay? Most people, when you're young, you're starting off, you're not thinking that, hey, I'm gonna, retire. Like, you're not even thinking about retirement. You're thinking, hey, I make money right now. Maybe I make $100,000 in this new job I got. And, maybe one day I'll worry about retirement. Maybe one day I'll start a business and not have to think about, putting money into my 401k. My business will make money for me, etc. But look, you're young, right? So in this demonstration here, as a 35-year-old, just starting off, maybe you have a family, maybe you just got married, maybe you're looking for a spouse, but you're just starting off, you're age 35. If you just start with $1,000, right, into the investment account, and you contribute $1,000 monthly, and you just make that a habit, you just have it going automatic for you, right? 10 years from then, you'd be 45 years old. But guess what? 10 years later, you're married, right? You have preteen children, right? These kids are young, and you're starting to think about their investment. You're starting to think about their future and what you can potentially hand down to them. But luckily for you, you started investing 10 years prior, and now you have a balance of roughly over $200,000 into that investment account. Again, this is just your investment account, not your 401k or IRA or your real estate or the equity in your home. This is just the investment account. You already have over 200 grand, and your kids are young, right? So look at this. 15 years later, you're 60. Your kids are graduating high school, college. You're married with college age children roughly. Now that balance that you started 25 years prior is that account that you started 25 years prior is now the balance of $1.3 million. That tells you the power of this compounding interest, this growth of this investment fund, this investment vehicle that you put money into every single month, 25 years prior. And again, that's just with $1,000 balance, $1,000 a month. Again, if you have a much higher beginning balance, it will be much higher than $1.3 million. Trust me. If you put in more than $1,000 a month, right? Or every now and then you get a bonus at work, and then you put all your money into the investment account and you buy the ETF or mutual fund or index fund, right? If you did that, you would have way more than 1.3. 1.3 is the baseline of what I'm trying to illustrate here. This should be much higher. And again, you're 60 years old in this illustration. You're just 60. Maybe in some cases, if you started this earlier, you're in your 50s. You're in your 50s. See, you're in your 50s. You're not as old as you think you're going to be when you're 50. Like, you're still going to be somewhat agile. You're still going to want to do things and travel and have fun and buy fancy cars. Like, you're still going to want to do stuff. So you're going to need money to do those things. And if you start early, start early with investing as often as possible, and as much as you can, then you can really live in style. You can retire in style. You can retire early. Again, it's important to start now. The next 10 to 25 years will come by super fast. Give yourself more financial and career flexibility as you get older. Again, and also the last point, building generational wealth. You saw in that previous slide, that couple ended up having college age children at the end of their 25-year cycle of investing. Now you're starting to think about, what can I pass on to my children? Can I pay for their wedding? Can I help them buy their first home? Can I give them a lump sum of cash so that they don't have to feel like they are forced or required to work every day? Maybe they can go into business. Maybe they can do other things, right? So you want to put yourself and your lineage, quite frankly, in the best position possible. And the best way to do that is to start thinking about investing early and as often and as much as you can. So with the approach that I'm going to walk through today, I'm going to really emphasize simplicity. As I said at the top, complexity can often become the thief of wealth building. You don't want to add in too much complexity. Many of you guys, if you go on YouTube and you listen to influencers talk about investing and stocks and buying, Forex and, buying options and all that, like, forget about that. Like, that's complex stuff. And a lot of times complexity is often there to steal your money, to take your wealth, to trick you into giving up money, right? But when things are simple, you can follow them consistently. You can build habits around them. You can do it consistently for a long period of time. It's a more durable approach toward building wealth if you can simplify your approach, right? So I'm going to really try to hone in on this piece in the remaining slides here. So how to start. There's 4 steps. You set up your brokerage account, you link your bank account to your brokerage account, you schedule your monthly deposits automatically, reoccurring, and then you also schedule monthly recurring investments. You can do all of this again by following these example videos here in this slide. Again, I'll link to the deck in the show notes. But this is a simple approach and path towards just getting started, right? Because once you get started, you're off to the races. This is something that everyone who's watching this video, if you haven't done this thus far, if you don't have a taxable brokerage account or an investment account, you can do this today. 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 And I want you to do this today. So make it a goal to set this up for today. Now, which brokerage should I start with? There's a number of brokerages out there. There's Vanguard, there's Fidelity, there's a ton, right? There's Robinhood. You might have heard of a lot of these names. I'm going to make it very simple. Just use Fidelity. I use Fidelity. Just use Fidelity. Fidelity it's simple UI. It's easy to use. Just use Fidelity. See, I'm making it simple. I don't want to sit here and give you comparisons between the different accounts and all that. You can do your research and all, but this is what I would tell my kids. Just use Fidelity. Why? Because see, we want to get started. We don't want to get hung up on the research piece and all that. Like, just get started, get going, set it up. Let's get the ball rolling. So use Fidelity. Now, what should I invest in? VTI. Now, what is VTI? VTI is Vanguard Total Stock Market Index Fund ETF. Vanguard also has an index fund version of this called the VT-SAX. I've bought into both of these before, but VT-SAX is preferable if you were not charged a $100 commission fee by Fidelity, because every time you acquire VT-SAX, Fidelity charges you a $100 commission fee. So unless you're investing a large sum of money, I would not recommend going into VT-SAX initially. VT-SAX also requires a $3,000 minimum, so you have to invest at least $3,000 to start your investment into VT-SAX, and every subsequent investment, you will then you don't have to then meet that minimum threshold. But again, in Fidelity, they charge you $100 commission fee. So unless Fidelity removes that commission fee, I would recommend going into VTI. VTI is just the ETF version of the VT-SAX. So it's the same growth pattern. You can look it up, search Google, search VTI, search VT-SAX in another tab, and look at the growth over the last 5 or 10 years. It's the same. It's basically the same basket of stocks that sit within these index funds. So VTI, again, does not require any account minimum. You can buy it even fractionally in Fidelity. So if you invest like $1 right into VTI, you can buy fractional shares of VTI. If you invest $10, you can buy fractional shares of VTI. VTI, I think, currently is priced at like $250 a share, I think. You can invest lower than that and still buy into VTI. So that's why it's a really attractive option for those that are starting off, wanting to build sort of a reoccurring investment cycle, reoccurring investment scheme, right? In your Fidelity account. VTI is the option of choice here, and I use this currently. So again, VTI, just buy VTI reoccurringly every single month, as often and as much as you can. Again, in the previous slides, you saw the example with $1,000 every single month. You can go more than that. If you don't quite have $1,000 to invest every single month, you can maybe start lower than that and then try to build your way up to at least $1,000 at some point. Now, what is VTI or VT-SAX? Again, as I explained earlier in the previous slide, VTI really is just the ETF version of the VT-SAX. They're effectively the same, but again, VTI is preferable in Fidelity, especially if you're buying on a recurring basis with the set amount every single month, like $1,000 a month. I would, again, definitely recommend VTI. So quick overview of accounts. This slide hopefully just kind of illustrates, and it's simple. You don't really have to follow this pattern, but I'm just trying to demonstrate, again, kind of aiming for simplicity here, demonstrating what your account setup might look like overall when you're sort of setting up this whole recurring investment scheme. So, everyone has a checking account. Your checking account really should only be used for spending, money, paying bills, your daily consumption habits, buying food, groceries, etc., right? Then you should have an emergency savings, which really should comprise of roughly 6 months or so of expenses, at least 6 months of expenses. So if you spend $5,000 every single month in your total bills, including your rent, your mortgage, and everything else, and your food and gas and light bill, water bill, etc. If you spend $5,000 every single month, then a 6 month emergency savings should have at least $30,000 in it. Once you've reached that 6 month expense minimum, keep that money in a high yield savings account. Don't touch it. Only in the event of an emergency would you ever touch it, right? And if you do touch it, then you're going to have to replenish that amount back up again. So which means you might have to pause investments until you can replenish your 6 month emergency savings threshold. So that, again, super important to have emergency savings. This is going to become like your protection mechanism against you ever having to liquidate your investment holdings or your investment accounts just to take care of an emergency. You don't want to do that, right? Because now you're kind of starting over again. So the emergency savings account is sort of it's like your backstop. It will protect you from having to touch investments or liquidating your 401k in the event of an emergency. Now the third piece, you should have an excess savings account. Again, this can also be a high yield savings account. Another alternative to this is that you can actually use Fidelity. Fidelity also has like a sort of like a savings account option within the brokerage account. So it also offers, basically a way to save money. I think almost in a money market fund type scheme, but either way, you can use Fidelity or you can use your own bank account and have another savings account called the excess savings account. This is where all the excess money goes to. So if you're budgeting wisely, you know that, hey, I spend a certain amount of money every single month, right? I spend $5,000 a month. So every month my checking account will have to have at least $5,000 because I'm going to go through all of that. Your emergency savings should have $30,000, right? Just sitting there in high yield savings. And then your excess savings, if you make more than $5,000 a month, let's say you make, $10,000 a month or something from your check, then your excess savings should have $5,000 going into it every single month. And this $5,000, out of that, at least $1,000 should feed right into your brokerage account. Now, if you're getting an excess $5,000 a month, I would recommend just investing the whole $5,000 into the brokerage account every single month. But $1,000 again is sort of like a good baseline to start with for those that are trying to figure out how to do this and understanding their budget a little bit better, so they can try to invest more than $1,000 every single month on a reoccurring basis. But again, excess savings, you want that to feed directly into your brokerage account. Again, in the previous slides that I touched on about setting up that monthly reoccurring deposit, have that coming directly from the excess savings into your brokerage account, again at $1,000 a month rate. And then again, any bonus or excess money that you have coming in, you get a year-end bonus, you get a sign-on bonus at a new job, you get some Christmas money, you get some birthday money. Throw that into the brokerage account, right? Ideally, your excess savings account should be almost at zero at the end of the month, right? Because all of that money is going into the brokerage account. All of it is going into the brokerage account. I know this might come as a shock to those that are so used to like saving money and just kind of having it sit in the shoebox or something. But don't worry, your emergency savings account, right, is the backstop from you ever having to touch your investments or your 401k, right? So you have savings. It's called your emergency savings, right? Don't worry, it's there. And then your checking account is just taking care of all of your consumption during the month, right? And your excess savings should be depleted at zero. Why? Because all of that money is flowing into the brokerage account, right? That's how you want to think. That's how you want to operate. You don't need to have a ton of, excess money just sitting around in a bank not earning any interest. Like, have it sit into an investment for you. Again, so long as you took care of the emergency saving piece, you're good. Just invest the rest into your brokerage account. Cool. So hopefully this is, again, a simple, quick, chart of how, your account might be set up, but you can modify yours in any way that suits you. But this is what I would recommend just so you can get started on your investment journey. Another thing I would recommend is not to buy individual stocks whatsoever. Trust me, I've been there, done that, been burnt, not doing it again, not buying individual stocks. People that try to become stock pickers will get burned. You're not going to outsmart the high frequency trading algorithms. You're not going to outsmart the day traders that sit in Wall Street, the prop traders. You're not going to outsmart them. You're going to get burned. So just get away from that. Like you're a retail investor. You're going to get burned. So your best bet is to invest in a index fund or ETF that effectively holds all of those companies. So really what you're doing is in effect, you're buying into the total stock market. Again, that's why they call the Vanguard, the VTI, the total stock market, Vanguard's total stock market index fund, ETF. You're buying into the total stock market, which in effect is actually mirroring the US economy, right? So in a way, you're kind of buying into the US economy. You're buying into the GDP growth of the country year over year. And we expect that growth should constantly, we expect the GDP to grow every year, right? Unless there's a recession, in which case you will see some retraction or some regression in your investment. But nevertheless, we expect to get out of those recessionary cycles and back into a growth pattern. So that's the key. You want to kind of put your money into the economy in a sense. So in effect, the economy is kind of doing work for you. It is growing. It is also generating value and excess interest in the way of returns, right? Back to you as the investor in this case, right? As the holder of BTI, right? The economy is basically building that wealth for you. So you don't have to do all the work by yourself anymore, right? In terms of trading your time for money. Instead, the US economy is doing some of that work for you by growing roughly at a 10% annualized rate of return year over year, right? So that's how you want to think about things. Don't buy individual stocks, buy the ETF, VTI, right? Buy VTI. In closing, again, I touched on this very early on. Max out your retirement contributions. Do it today. If you don't know how much you're contributing into your 401k, your IRAs, look into that. Make sure that you are retiring. You are maxing out at least up until the employer match, so you can get the match from your employer, right? That's free money, and or you can just simply max out your contribution to the legal limit, and then also invest $1,000 every month into VTI. We touched on this earlier. I walked you through how to do it and how to set up your account schemes and all of that. Do that as soon as possible. At the very least, you should set up your account, right? Just have it set up and even contribute as much as you can. Maybe it's $5 a month. Maybe it's $10 a month. Maybe it's 50, maybe it's 100, but you need to get to 1,000. And I think the more I think even for those who might find $1,000 a challenge to invest in every single month, I think if you start with 100, 200, 300, knowing that $1,000 a month is your goal, you will be motivated to cut costs around you. You will be motivated to earn more so that you can get to $1,000 a month. Why? Because you know that $1,000 a month over the course of 25 years is going to give you roughly $1.3 million. So you know that that's the goal you're trying to chase. You're trying to chase early retirement or a graceful retirement, right? So you'll be motivated to cut costs and or make more money so you can get to that minimum of $1,000 investment every single month into VTI. And lastly, stay out of debt. Again, avoid debt as much as possible. Avoid credit card debt. Avoid taking out loans to buy cars. Like, you don't need to go to the dealership and be in debt for a vehicle. Pay for a car cash. Save up the money until you can get the car that you want. Right? Stay out of just debt in general. Avoid it like the plague, because debt will eat away at your ability to contribute every single month into VTI or even into your 401k, and it will eat away from the distributions that your 401k will one day give you and what your investments in VTI or in these funds in your brokerage account will give you. It's going to eat away at that. It's like a parasite. So get rid of debt, stay out of debt, control it and minimize it and get rid of it altogether. Again, if you have any questions, feel free to reach out. You know where to get, how to contact me. Hopefully this was informative to all that are listening. Again, invest as early and as often and as much as you can, period. So thank you. And hopefully you all learned something today.